Good morning, everybody. Thank you for joining us today for building budgets that work. Some financial planning practical tools for nonprofits and other small businesses. We're going to give the room a couple of seconds here to fill in before we get started. So if you have a half-empty cup of water and you think you might need to fill up, go ahead and get that taken care of before we get going here. And as we wait a few more seconds for people to filter into the room, I do want to remind everybody that we do record our webinars, including this one, and any registered participant will be receiving a copy of the recording via email in the next couple of days after we do some retouching of it, put some finishing pieces in there. And as always, we use our Q&A function. So if you have questions for our presenter today, please feel free to put them in the Q&A and we will warehouse the questions and save the last 10 to 15 minutes at the end of the presentation so that Mike can answer whatever you have for him. So once again, thank you for joining us on this beautiful Wednesday morning. I'm Peter Benson with Park Bank. I lead our Treasury Services and Community Engagement team, and I'm very proud to present a friend of show, Mike Hablewitz with Wegner. Mike is returning to give us his professional insight and his expertise. I can tell you from experience with nonprofits that I've worked at that Mike is a fantastic accountant, a fantastic advisor, and a great human being. And with that, I would very much like to welcome him back joining us. Thanks, Mike.
Awesome. Thank you, Peter. I appreciate that. That's very kind words. I appreciate that. I'm glad this is recorded. Maybe I'll play it back for my wife and kids so they can hear that. But yeah, in all seriousness, thank you for having me back again. As we talked about earlier, it's been a little while, but really a pleasure to be back speaking here with the Park Bank webinar. We're going to be talking about budgets today, and my goal is to, as Peter mentioned, kind of get done with some time left at the end with questions. But if people have questions throughout, I know Peter will be monitoring the chat. So I'm all for interrupting. So I'm happy to stop and try to answer questions along the way. So if you have questions, don't feel the need to wait till the end. So I know budgets maybe aren't the most exciting of topics, but I think it's very important when we, as an auditor, that we see organizations that are fiscally responsible. It kind of starts with the budget. So it is a necessity at the front end. If you want to have good financial results, you usually need to be doing a good budget at the start of the year and then monitoring that and analyzing that throughout the year. So we'll talk about how budgeting is a process. It's not just something you do before the year starts. So maybe just some budget basics to get off and running here. So the first and most important step to successful financial planning is developing and implementing a budget. So like I just mentioned, if you want to have good financial results and be able to earmark and benchmark how you did during the year, you need that budget up front so you can really analyze those results. Without a budget, it's difficult to truly measure your success. And we'll talk about it later on, how just having a net income for the year doesn't automatically mean it's a good year, or how having a net loss for the year automatically means it's a poor year. So the budget is really that frame of reference that is needed to analyze your results. Definitions and terminology. So we'll just go through kind of some basics, some terms and some definitions, and just some things to think about as you're trying to kick off the budget process. So what is a budget? Today, we're going to be talking about just what I term, or what is called, an operating budget. So think of it as your budget for your organization most likely for 1 year, for one fiscal year. So a budget is simply the estimation of your revenues and your expenses over a specified future period of time. Of course, again, the most common being just that 1 year or for the fiscal year. Some organizations will break it down month to month and have a budget for every month and also analyze. We'll talk about that later too, just analyzing it either on a monthly basis or just in relation to the annual budget. So not necessarily a right or wrong there, but some organizations will break it down for each month. Some will just have an annual budget. Budget process. So this is the way an organization goes about building and monitoring its budget. So because I'm an auditor and we always want to see everything documented, we're kind of a pain like that. The process should be documented. So who is involved? It's naturally going to be an accountant or CFO type person, an executive director or CEO, president, whatever the term may be or title may be. There could be program people involved, program directors, let's say. There could be a development director involved. If you're looking at trying to budget as part of the overall budget, what do we see for contributions for the year? So there can be a variety of people involved. So document who is involved. When you're going to start with that, you'll see this littered throughout the presentation today a few times. You'll hear me reiterate it. Start early. The budget should be done before the year or the period that it applies to. So have it in your documentation or your process that you document when you get started on building that budget, and ideally even when you're going to approve it. So if you have a board meeting in November, December, kind of, this time of year or coming up shortly, this is a good time to hopefully be working on it and have an upcoming meeting here where it is approved by the board. Who monitors it and who's responsible for adhering to it. So again, I kind of like to think of it as management. Management certainly monitors it as well, but management really builds and uses the budget, and then really the board is the one charged with technically monitoring it. And then part of the document, if you do document this process, it would be how do you handle variances? We'll talk about that later as well, just not trying to get into the weeds on every little variance, but what types of variances do you want to look further into to make sure you understand for good and bad variances. If you're over budget on expenses, let's say, or maybe you're under budget on expenses, why is that? And then when do you amend or revise the budget? So a couple more terms here yet. Variance analysis. So this is just pretty common sense, but comparing your budgeted numbers to your actual results and making sense of the differences. So again, I mentioned people do it or organizations do it a little bit different, looking at monthly or annual numbers, but really on a monthly basis, you want to be comparing your monthly numbers to the budget. If you're doing it, the budget broken down by month, compare the month to the month. If you're doing just an annual budget, it might make more sense to compare year-to-date numbers. So if you're a December year end and you're at the end of June, okay, we're halfway through the year. Are we kind of in line with halfway, our expenses kind of at about the halfway point? Are the revenues about at the halfway point? Consider the remainder of the budget period, like I mentioned, just if you're at that midway point. Also consider, do you have fluctuations in your revenues and your expenses where it's not ratably throughout the year? So you don't have maybe you have much higher expenses in the second half of the year, or your revenues are very heavy in the first half of the year. Consider that when you're looking at your variances. And then identifying trends and discussing them. So if you're at that midway point for the year and hey, we've been over budget every month on a certain expense line all 6 months, is that a trend that's going to continue for the second half of the year? Or is that something, no, we are heavier on those expenses in the first half of the year, so we are kind of in line with the overall budget and we expect to end the year okay. So those types of things. Few different approaches to budgeting. So I think probably the first and the second here are much more common. So the income-based one, budget revenues first, expenses second, kind of see how it shakes out. Are you hopefully budgeting for a net income? If not, are you comfortable budgeting either break even or for a net loss? Incremental, this is probably the most common. Start with the prior year results and then build the budget with percentage increases or decreases. Hey, we're giving staff a 3% increase this year. We have the same staffing levels that we did the year before. We can take last year's results, add 3%, and that's going to be our budgeted wage expense, for example. So incremental is a pretty common way to go about it. Zero-based is just starting from scratch and reevaluating everything. I think that's pretty uncommon. Maybe might be necessary, obviously, if you're starting a new organization, you're starting from scratch. But I think in most cases, organizations are using the income-based or the incremental. One thing I'll throw it in here, I'll probably mention it again later too, but be careful with budgeting revenues last. I have seen that before where the budget is exactly break even, but maybe there was a number that was plugged on the revenue side and maybe wasn't necessarily attainable, but that was done to just show a break even budget. So kind of budget those revenues first. What are you really expecting for revenues? Filling in your expenses second if you're using that income-based approach. Don't go the opposite. Budget narratives. See some organizations that use this extensively, some that don't use it much at all. But consider having written descriptions that supplement the information in your budget. This can serve a couple of purposes. It can explain how you arrived at those amounts, some assumptions that you've built into the budget, and it can also justify the need for the cost. If it's something, particularly if it's something new, it's like, hey, this is a new line item in the budget. Why? What is this? Well, here's an explanation, or here's a justification for that. It also can be good not only for new line items, but if there's something that's being budgeted substantially different. Hey, we've always budgeted this at $50,000 or in that range, and now we're budgeting it at $100,000. Here's why. So those budget narratives can really provide some more background on some of the numbers in the budget and can be really helpful to people who are maybe not building out the budget, but if you're the board member who's monitoring it, to have those narratives to provide more of a frame of reference on some of those numbers can be really helpful. Some advantages of having a budget certainly shows fiscal responsibility and promotes efficiency, keeps people from just blindly spending. I think it's, kind of resist the urge to quote, operate out of the checkbook. So some organizations might feel like, hey, we're in a strong cash position. We have the ability to spend. And while there may be some truth to that, you want to have fiscal responsibility and some benchmarks. You want to have that budget as a guide to promote fiscal responsibility and efficiency so that there isn't that overspending. And then you get to the end of the year and maybe the results are not what you had hoped for. Sets financial goals for an organization. Really, the budget is a goal. Hopefully, it's a goal that you can exceed. I mentioned earlier, just if you have a profit doesn't necessarily mean a good year, or if you have a loss doesn't necessarily mean a bad year. So I have some organizations that really have expenses that fluctuate greatly from year to year for a variety of reasons. For example, if you have an organization that holds maybe a huge conference every other year, maybe in the off years, the organization really needs to have a net income because maybe in that year that they're holding the conference, they're projecting to have a net loss in those years. So maybe having a net loss, but maybe it's less of a loss than what you anticipated. That could be a sign of a good year because the loss was less than what you had budgeted for. I also see that occasionally with organizations that maybe are spending a fair amount in election years versus non-election years. So in those off years, again, they're budgeting for net incomes. And then in the years where maybe they're spending a lot more based on the election cycle, that they're expecting a net loss in those years. So I always want to have that budget as a guide to see, hey, even if we have a loss, could be a good year. Even if we have a gain, might not be as good of a year as we had hoped for. And then the budget also helps develop expectations for those that are responsible. So particularly if you're building out a budget and you have an organization-wide operating budget, but you're incorporating potentially called departmental budgets or program budgets, however you want to term it. So if you're rolling those up into that overall budget, make sure that you're involving those program directors, if you will, in the budget discussions and setting it. And then those become the expectations for their department or their program, so that you can track how the spending or the expenses and revenues potentially too for those programs, do they make sense? And are the program directors monitoring those expenses to keep them in line with their piece of the budget? So what can an effective budget do for your organization? So having that budget helps forecast future problems or opportunities. So we'll talk more on the variance analysis further in the slides here, but using that budget to identify future problems or problems maybe that are starting now could become bigger problems down the line. The budgets can also highlight opportunities. Are there things where, hey, our revenues are up substantially in this area, more so than we expected? Is that something that we want to pursue even more of so that we can continue that momentum? The budget also provides a roadmap, keep you on track with long-term goals. We'll talk about reserves later as well. So if you have long-term goals, to build a reserve, whether that's an operating reserve or maybe a building reserve, you want future building or just improvements to a building. So there might be longer term goals. Each budget can kind of can be a stepping stone for those longer term goals. And then the budgets help ensure resources are just used wisely and they align with the organization's goals and the mission. I'll talk a little bit about some essential elements of effective budgets. So I know we have a variety of people joined on the call today. I believe from the list I saw ahead of time that we have directors of finance, we have executive directors, we have probably board members, maybe some program people or development people. So I know that there's probably a varying level of involvement with budgets and understanding budgets and financial statements, but always make it easy to understand. You want it to be something that if board members particularly are monitoring it, that you need it to be understandable. So you need it to make sense. It needs to obviously be as in depth as it needs to be for it to make sense for the organization, but it needs to be easy to understand. And again, that's where those narratives can come in helpful. In some cases where it's, hey, we have a board that maybe doesn't have a lot of financial acumen. Let's make it super easy to understand. And then let's provide some narratives, some background on some things to make it even more understandable. Make sure your budget is based on the fiscal year. That should be kind of self-explanatory, or obvious, but make sure that the budget is based on the fiscal year. Notes here, if you're doing a project-based budget for a certain project or a building project or something like that, that's obviously going to have a different term or a different life. But here, really encourage people to build out a one-year budget. Some organizations will do multi-years. Then you kind of get in the semantics of budgets versus projections. But generally speaking, a one-year budget makes the most sense. Mentioned it earlier, I'll say it again, prepare it before the applicable fiscal year or the project period begins. So always best, it's hard to monitor it. on a monthly basis if it's not done before the period that it applies to starts. And then using appropriate accounting basis, cash versus accrual. So generally speaking, it should be on the accrual basis. I'll have a few slides on that too, where we'll get into more depth on the accrual basis. But generally speaking, unless you are doing cash basis financial statements, I would highly encourage that the budget is always on the accrual basis. Consider your fixed costs versus your variable costs. So when you're building out that budget, there's certain costs, whether they're fixed salaries or they're fixed rent payments, things like that. Hopefully those are pretty easy to budget because they are more fixed versus variable costs. Can be things that just fluctuate based on how many people you're serving. You know, hey, we're going to need a lot more supplies. We're going to need a lot more food. We're going to need more travel expenses. Whatever it may be, that might be dependent on how many people you're serving and just other factors. As we all know, there's other variables just in rising costs and such too. So it can be based on the number of people you're serving, but it can be other variables too. But when you're building out that budget, sometimes hopefully it's pretty easy to come up with the amounts for those fixed costs and then spending a bit more time on those variable costs. Another essential element, it should be shared with all the people that are responsible for adhering to it. So don't involve program directors and the development directors and then not involve them in monitoring it, sharing results with them, so that if they're going to be held responsible for adhering to it, make sure that it's always shared on the front end when it's officially set and approved, but then also sharing results throughout the period. Budget should always be frequently monitored and the variances should be analyzed. It doesn't pay to do a budget if you're not going to monitor it and then analyze the variances. That's what helps you keep you on track and hopefully stay within budget by analyzing those variances. You should consider non-cash items such as depreciation. Again, I'll go over that in a bit when we talk about cash versus accrual. Depreciation, many of you know what that is, but just depreciation on your building and your other fixed assets, vehicles and equipment, etc. So that does factor into your bottom line. It's not something you're writing a check for per se, but it is something to consider and have as part of your budget when you're looking at budget versus actual results and you're on that accrual basis. Depreciation should absolutely be a factor. And then make sure you're aligning your budget line items with your financial statements. So, for example, if you're using QuickBooks, that's the accounting system that you're using, and you have 25 different expense lines in QuickBooks. You have wages, payroll taxes, benefits, rent, utilities, travel, insurance, so on, professional fees. Your budget should have those same line items. So make sure that both on the revenue side as well. So make sure that your revenues and your expenses always have budget line items that mirror your financial statements. If you need to break out something further, if you feel the need to do that on a budget, I would strongly suggest that you consider whether you need to be breaking out things further on your financial statements then so that they mirror each other. All right, designing a budget to meet your organization's needs and goals. So initial planning, as you're getting started on the process, as I mentioned already, make sure you start early. Too often the budget isn't prepared and or approved until into the period in which it applies. I had a client recently who did not approve their budget for a variety of reasons until March, their December year end, and really caused a lot of issues and concerns. By the time they got to the end of March, they already had a pretty significant net loss for the year. And It's just part of the reason was there was not this benchmark, this budget in place yet. And when that happens, spending can potentially get out of control. So don't wait till March to get your budget in place if you're December year end. Revisions may be necessary. People or organizations amend or revise budgets. Certainly can do that, and sometimes it's appropriate to do that, but don't overdo it. If something goes over budget, that doesn't mean you automatically just, hey, let's go amend the budget so now we're in line with budget. That probably doesn't make sense. I would say revisions are more appropriate when there's a very substantial change. Hey, we find out in March that we're losing a grant that renews July 1. So now we're going to have lower revenue from July through December. You may want to do a revision based on something like that, but don't necessarily amend a budget. I don't think it makes sense to amend a budget if, hey, we budgeted this expense at 10 grand. Now I think we might actually end up at 15. That's okay. Let that variance be there so you can analyze that variance and see, is it something that, did we budget it wrong? Is it just a one-off? Or is it something that, hey, we need to keep that in mind for future budgets because it's probably going to be a higher cost going forward. Initial stages, again, select your accounting basis, cash versus accrual, and the budget approach, which I mentioned earlier, those 3 different approaches that you can use, incremental being the one, again, that's probably the most common. And then involve all key decision makers. We've said it a couple of times, be specific on who is responsible for what and make sure they're all involved. A few other things in the initial planning stages, prior period numbers, use them. Those prior period results are very helpful when building out an accurate budget. Consider using more than just the prior period if appropriate. So in my examples earlier about organizations that maybe fluctuate every other year, for example, if you're setting the budget for next year, you may want to use the results from 2 years ago. Those might actually be better barometer or better starting point for the budget than last year. Using the budget narratives, like I mentioned earlier, you don't have to get crazy with those, but having a few, at least in most cases, makes sense. And then always have it formally approved. Make sure it's in your board minutes. You set aside time at a board meeting to allow enough time to really review that budget, make any tweaks to it, and then have it formally approved and documenting that it's formally approved. Accrual versus cash. So here's where I mentioned we get into a few nuances with depreciation and other things. In most cases, accrual is the best because I always use this example. I remember doing an audit for an organization on the cash basis years ago, and I won't get into the nitty-gritty details, but they really didn't pay much for any expenses the last 2 months of the fiscal year. They had a lot of old kind of outdated bills, outstanding bills that they were behind on. Well, if you're operating on the cash basis, you look great if you don't pay anything for 60 days. So accrual basis is much better in the sense that those last 2 months worth of expenses, they are in your expenses when you incur them, say in November and December, if you're December year end, irrelevant of when you actually make the payment. So almost always accrual is the better route to go for your financial statements and for the corresponding budget. But if you want to kind of consider the effects on your cash from the projected budget results, a few things to keep in mind. So you take your revenue minus your expenses, that's going to equal your net income or your net loss. If you want to look from a cash basis, you're not writing a check for depreciation expense, so you can add that back to your net income. Then you subtract out if you have a few other things during the year, if they're applicable to you. If you have debt payments, the principal portion is paying down a liability on your balance sheet. That is not an expense. But that is cash out the door. So you would subtract your debt principal payments. And then similarly, subtract any purchases of capital items. So equipment, building improvements, etc. Those, if you're not financing them, those are cash outlays too, but they're not showing as expenses because they are assets that are being capitalized on your balance sheet. So those are a few things to consider when you're kind of looking at an accrual budget, but how is that going to correlate with my cash? So that's why sometimes maybe in conjunction with a budget, some organizations will do a cash flow projection as well. So maybe just something to highlight this. I'm going to attempt to stop sharing this screen and pull up a different screen here. Hopefully, Peter, could you maybe just confirm that you see that spreadsheet?
We see the spreadsheet.
Perfect. So here's just a very basic, simple kind of budget with some other financial information in this scenario, just as I was talking accrual versus cash. And because a lot of times while things are on the accrual basis, cash is king, as they say, and a lot of organizations still want to see how do we project for cash. So here you can see just budgeting, revenues, contributions, program service fees, sales, if you will, investment return, total of $1 million. Here's your variety of expenses, including a depreciation number of $30,000 that you're not writing a check for. Come down in this scenario, you're budgeting for an $80,000 net income. On the right-hand side here, just building in some scenarios or some assumptions, $45,000 that you're going to pay for a new roof, not financing it, you're paying for it. And then your principal payments on your debt for the year were $10,000. So how does this scenario affect your cash flows? And in this scenario, I'm treating investments and cash as one. Since we're in the budget, we say there's a $100,000 investment return. So your net income is this $80,000. Your depreciation expense is something you're not cutting a check for. So you're adding that back in. And then here are your cash outlays for these two items that are not in your expenses. They're not over here because they are on the balance sheet. So that $45,000 for the new roof, $10,000 for debt principal. In this scenario, the net projected increase in your cash / investments is $55,000. In this scenario, there's $100,000 of investment return. So in theory, your investments went up 100. With this 55,000 here, that would actually mean your true cash would be down $45,000. So that would suggest that you might need to be drawing from your investments for cash flow purposes. So just something to kind of portray how the budget ties into the cash flow and cash projection for a year. Now, you could even do something like this while this isn't part of your revenue and expenses as part of your budget, this could almost be a narrative essentially, or something that you build off to the side or beneath your budgeted numbers to just give the board and anyone else that's reading the budget some additional information on how this budget will affect the balance sheet as well, namely the cash and investments. All right, I'm going to go back to the slideshow here. All right. Peter, maybe you could just confirm again that we're back on track.
You got it perfectly. We are back.
Awesome. Thank you. I'll keep my eye on the time here, make sure I allow some time for some questions at the end. So furthermore, on accrual versus cash, generally the budget should always be on the accrual basis and factor in things like depreciation expense, repayment of debt principal, et cetera, like we just walked through. You can consider those things in conjunction with the budget. So budget revenue and expense amounts for the year. So this kind of goes back to the example I just gave about not paying a bill if you're on the cash basis for the last 2 months. Well, budget your revenue and expenses for the year, meaning if you have your expenses that are for January through December, again, assuming you're December year end, budget them for the period that you incur them. regardless of when they might be paid. It's because obviously there's bound to be December bills that aren't paid till January. Budget those expenses in December. That'll mean you're on the accrual basis. And then, yeah, here, just only do a cash basis budget if your financials are on a cash basis. Vast majority, if you're doing an audit, particularly for a funding source or for the state of Wisconsin, for that matter, if you need to attach one to your Wisconsin Form 1952, depending on what your contribution revenue is, almost everybody requires your financials to be on the accrual basis anyways. So again, if that's the case, make sure the budget's accrual as well. All right, a few more just comments on purpose of the budget before we talk about variance analysis and kind of monitoring results. Purpose of your budget, keep you in line, as we mentioned, with your future vision and your plan. Motivation, I think maybe that's something to consider too, is when you have that budget, there's a motivation to stay within that budget, and empowerment of people who are part of that budget process. You're empowering them to set that budget or their piece of the budget, and then empowering them to monitor and kind of track their expenses and take ownership of their spending to stay in line with the budget. You can also use the budget to set performance standards. We see this occasionally where results, budget versus actual, can sometimes be tied into staff compensation or bonuses. It's not very common, but sometimes you see that hey, if you do better than budget, potentially there could be people involved with the budget and the finances that would be eligible for some sort of bonus if they're doing a great job controlling spending and or increasing revenues. A few other purposes: identify trends earlier. You can take advantage of opportunities if you see positive trends. You can hopefully identify problems early on and determine the course of action sooner if you're using that budget versus actual analysis. You avoid those costs spiraling out of control. And yeah, analyzing those variances is really important. And sometimes analyzing amounts that don't have a variance, where maybe at some point during the year you're expecting to see a variance based on how you set the budget and how costs have maybe been increasing. Maybe if there aren't variances and you're expecting one, we'll talk about that too. And then break-even analysis and other what-if scenarios. I do have some clients that will essentially do a couple versions of the budget. The main budget, if you will, is the one that is really their expectations. Like, hey, this is our budget. This is really what we project. There may be another what-if scenario or a break-even scenario. Maybe there's a second version of the budget, if you will, that is, hey, here's what we would, if we were budgeting for a loss, let's say, here's what we would need to do in order to achieve a break-even year. Or here's a what-if scenario if we do lose that grant in the second half of the year. This is what the budget we'll have to maybe revise our budget to this other what-if scenario if that unfortunately comes to fruition. So consider that as another purpose of the budget is you might want to have another what-if scenario or break-even analysis depending on the specific financial situation that you're in. Like most things, good planning leads to better results. So good budgeting should lead to better financial results. That just goes hand in hand. Budgeting allows you to forecast future needs and to develop your future goals. So having these budgets, comparing these numbers to your actual results, helps you accumulate historical data. Again, using that example where maybe the year fluctuates every other year or every third year, whatever it may be. Build up that historical data of actual versus budget, and that will help you project and have even better budgets in future years. Budget for building a reserve too, so consider that is you have that back to my scenario there where, hey, we're projecting an $80,000 net income on that spreadsheet that I pulled up before. If that comes to fruition, putting money in a reserve is not an expense. That's just setting money aside. But consider like, okay, if we have that $80,000 net income, if we achieve that, do we want to take 50 of that and sock that away in a reserve account where we don't touch it to just build up an operating reserve? So we're just on sound financial footing. Or maybe it's like, hey, we know we need to rehab the building. We need a new roof. We need whatever in a couple of years. Let's try to put $50,000 away for the next 2 or 3 years into this more specific reserve, so that in a couple of years, if we need that for maintenance or other rehab projects, that it's there. So consider that almost as a below the line item on your budget, revenue expenses. And then, hey, if we hit that, do we want to take part of that net income and put it away in a reserve? Almost considering that, treating it somewhat like an expense, even though it's not an expense, it's just setting it aside. All right, managing your budget. I know we're getting a little low on time here, so I'll spend 5 or 10 minutes on this and then we'll open it up for questions. So managing your budget, variance policy, have an amount and a percentage. Like, don't overanalyze trivial amounts. So something's $1,000 and it in the budget and it's at 1,200. Hey, we're 20% overspent. Probably don't want to get in the weeds on something for $200. So have an amount and a percentage that kind of guides whether you're going to dig into those variances for the most part. Likewise, if you have $1 million of wages and your wages is at $1,010,000, that's 1%. Is that really a percentage that you want to spend a lot of time getting into that, even though it's $10,000 over at 1%? Is that enough for you to spend time analyzing that variance? And then consider flexible budget concept. When you do a budget, if you have certain costs and revenues that they might be based on serving an X number of people. Well, if you end up serving a lot more or a lot less, just understanding that certain revenues and expenses can be more or less than what you budgeted for, because they're just going to fluctuate depending on how many people you're serving. Consider seasonal fluctuations. If amounts are not budgeted or spent evenly each month during the year. So if you're at the midway point, an expense maybe is only a fraction of the total that's budgeted for the year. Does that make sense? Or is that a sign that you're likely to be under budget? And on the flip side, if you're almost at 100% of that line item at the midway point, does that make sense because you just don't incur those expenses in the second half of the year? Monitor your spending every month. So you should be looking at budget versus actual monthly. I think that's a good idea to do that. Even if you don't have a monthly board meeting, I would share budget versus actual results with the board every month, just so that they can see how the organization is doing. I would say you can could or should monitor your spending even more if the organization is in poor financial condition or has cash flow problems. It may be necessary to be monitoring that even more frequently than monthly, but I would shoot for monthly, even if your board meetings aren't that often. Besides comparing actual results to budgeted numbers, consider comparing the prior period actual results as well. I think that provides another good frame of reference. I know we do that internally here at Wegner. We look at budget versus actual, but also actual versus prior year actual. I think there's a lot of value in looking at that as well. And then address overspent items quickly. Don't let that build. If you see this trend and you know certain trends and you know that they're not going to be reversible, address them quickly. Consider, are they fixed or variable costs? If they're fixed, maybe you can't do anything about it immediately. If they're variable, perhaps there's more you can do with it to reduce those costs going forward. And then sometimes, as you're monitoring, sometimes there are just we miss on certain things for the budget. Something that comes to mind sometimes are legal expenses. You never anticipate, having a legal issue come up. Well, so maybe you budget very minimally for legal expenses. Then all of a sudden you have a legal issue. that's a quote miss in the sense that, hey, we typically don't have that, so we don't budget for that. Sometimes that just is what it is, and it's bound to be over budget because of the specific circumstances. Measuring your profits and losses. So now looking at kind of more of the results. It's great to look at your profit and loss to budget, but then also just thinking even broader than that. Assess the performance of your organization. That's profit and loss. How did we do? But then consider your profit and loss and comparing it to potentially to some competitors or peers. IRS Form 990 is out there as a public document, so you can look up similar organizations, either in the area, or maybe you have a similar organization that's in a different community or a different state even. Can certainly use those 990s to kind of help assess where you're at and measure your results compared to others. And then also when you're measuring your profit and loss and looking at comparison to budget, understanding the different segments or activities of your organization. Do you have certain grants or certain programs that are really underperforming and that are becoming, a problem for the organization overall? Do you need to consider discontinuing something? Or on the flip side, is something doing really well, you want to consider expanding a program. All right. A few other things to consider when measuring those profits and losses. Consider your investment return, depreciation, and any large unusual items. I speak to these items a lot when I talk with boards after an audit. So in that scenario, and in the interest of time here, I won't toggle back to the spreadsheet, but that organization had an $80,000 projected net income. That was with a $100,000 projected investment return. So a lot of times I like to look at how are we doing? How's the organization doing without that investment return? Okay, if we just have zero investment return, that organization would have been projecting a $20,000 loss. So I think it's important to consider that. You don't want to have organizations that are too reliant on investment return to balance a budget, because while hopefully over time there's bound to be positive investment return, hopefully that's not necessarily going to be the case each year. So ideally you'd be able to balance that budget, and the investment return is just extra, assuming that it's positive. Depreciation, mentioned that before. Hey, our net income is $80,000, but cash flow wise, before factoring in those other things like the new roof in that scenario, but ignoring that, hey, if we had a bottom line of 80,000, we're not cutting a check for that 30,000 of depreciation. We'd have had $110,000 of adding to cash and investments. And then just any larger unusual items like a gain on if you sell a building, or just insurance proceeds from the office flooding, or just whatever it may be. Just consider what your profit and loss would have been without those items in there to see how you did more operationally, so to speak. All right, just the last slide or two here. What to look for when analyzing a budget: overstated projections. Were you overly optimistic or unrealistic on the revenue side? I mentioned that earlier. Avoid kind of the urge to overestimate revenue just to balance a budget. Be realistic so that the budget is something that is a realistic goal. And hopefully if you overachieve on the revenue side, great. But don't just plug a contribution number that'll balance the budget. That can obviously be dangerous. Analyze those significant variances, lagging revenue items, or overspending of the expenses. Obviously, are on the bad side. If you got those, you definitely want to analyze those variances timely. And then again, on the flip side, look for those positive variances to identify opportunities to take advantage of. Mentioned earlier, if you're expecting a variance and now there isn't one, that might be something you want to look at. So could be signs of something being miscoded in the accounting system, just an error, or not. This is a whole nother topic, but the budget can be an internal control tool. So do either when there are significant variances or when things are spot on, when maybe you didn't expect them to be spot on, is that a sign of potential fraud or wrongdoing? It's always possible. So if anything doesn't feel right when you're looking at your budget versus actual, follow your gut, follow up on things to make sure. You might have to dig into some numbers and even look at some invoices potentially or something just to get comfortable that, hey, this budget variance makes sense. So don't be afraid to dig into the details sometimes when something just doesn't look or feel right. And finally, just remember budgeting. It is a process. It should be ongoing throughout the year. So start and set it early. Monitor the results frequently, ideally monthly. Revise the budget when it's appropriate, but don't go overboard with that. Don't revise it just because something went over budget. But if there's a substantial change in the organization's activities, revise it as appropriate, and then use those results, the budget versus actual, for future decision making. Should help you for, building reserves, should help you for setting future budgets. Use the results of that budget versus actual analysis to drive your future decision making. That is everything I had. So I probably only maybe undershot or overshot on me talking and undershot on the time left for questions, but I'm available till whenever. So now I'm happy to answer any questions.
Perfect. Well, I do want to say again, thank you, Mike. Budgeting is a big topic, and it's an important topic for all organizations, and especially for nonprofits um, who are serving the public and sometimes using public funds or even private funds to do that. Having an effective budget does really help an organization standing out in the community. So we appreciate you sharing your insight with us.
You bet.
I am going to go ahead and jump right into questions. Krista is wondering, is it okay or recommended to adjust a budget if you know a large expense is no longer applicable? Like maybe getting bought out of rent so you don't have an expense at the end of the year, but you budgeted for it at the beginning of the year.
Yeah, I think that's where the revisions come. There is gray area there or discretion. I would say if it's a significant item, and realizing that significant could mean the dollar amount could be different from organization to organization or even person to person. But if it's really a substantial change in what you projected, a budget revision quite possibly makes sense. Like I said earlier, if something is projecting to go over, you should never end the year with your actual results being exactly equal to budget. You don't want to be amending it or revising it every time something's over or under, because I think it is important to understand why you're over or under. But if it's more of a one-off item and a significant thing like that, yeah, if it's, hey, we thought we were going to hold this conference in the second half of the year and now we're not, or then that very well does make sense to revise the budget. So now you have a new barometer or new goal to hit when trying to keep your spending in line with whatever those new numbers would be.
That makes sense to me. Thank you. There's another question here. Given the uncertainty around grant funding in the public space right now, are we better off reducing our income by like X percentage and then hoping we get a grant? Or do you have any great suggestions about how we try to present a budget when we're not certain what some of our important funding sources may be?
Yeah, I think I know I had a few clients here recently that work with Dane County, and it's like, well, they were talking about a 4% cut. Now maybe only 1%. And it just, what does that mean for us? And I think that might be where you potentially need that what if scenario, or maybe a potential couple different versions of the budget, at least initially. So, hey, we think we're going to have X cut in this funding. Yeah, we're hopeful that we can get that other funding or new funding potentially, but I don't know that it's at the point where we can budget for that. I would budget your most realistic and your best estimate on where you'll be, and then consider doing a what if scenario or a second scenario that's like, hey, this is if here's our budget if we get a 1% cut, but which we think is most likely. So that's what we're planning to move forward with, but we're not sure yet. Here's scenario 2 if we get a 4% cut, or if we get this new funding. So maybe even have a third scenario in that situation. But yeah, use that what if, and then maybe then you get to, unfortunately, as we all know, things don't always happen well in advance as much as we want to try to do the budget in advance. If you don't find out till December or January, hey, this is the actual cut in that scenario, it's 2%. You probably want to tweak that budget when it's a known cut. And now, hey, here's a revised budget with that exact cut that we know is coming to fruition. So yeah, take advantage of having a couple different scenarios. And then once things become more known, then settle in on what's your budget going forward.
Perfect. That makes a ton of sense to me. I know it's a little more work and a lot more explaining to your board, but I do think that sounds very logical and a rational way of approaching that from my perspective.
Yeah, and unfortunately, as we know, with most nonprofits being very just service driven, is like in that scenario, it would highlight that what if scenario maybe says, hey, you know what, if the worst case scenario comes, is projected, maybe that highlights, hey, we need to eliminate 2 positions or something like that. Hopefully it doesn't come to that, but those types of things might come to the surface by doing that what if analysis.
Yeah. Donna has sent in a question. Thank you, Donna. For a 3-year operational budget, what method is considered the best practice? She says she currently does a 3% per year for inflation with a slightly larger percentage of increase, I'm assuming, for wages and benefits.
Yeah, I mean, obviously, the further out you get, the more assumptions you have to build into it. So hopefully with historical data, Donna, you can do that pretty well, and say, historically, here's been our increases in wages on average. Here's been our increase in health insurance on average. You know, if you rent, if maybe that's a known, hey, we've got a lease that goes for 5 years, so I can project that out. So I think you're going to have to build in more assumptions, and maybe you need a few more budget narratives to go along with that. But certainly not a bad idea to budget out for 3 years. I think, again, most common is to do it for 1. But I think you just have to be, in that scenario, you have to be more willing and accepting that revisions for years 2 and 3 are just more likely to be necessary.
Excellent. Thank you. Time for maybe one more. You may have opened a mini Pandora's box when you touched on reserves. Question, somebody's wondering how much they should have in reserves. What's an appropriate level?
Yeah, great question. So as a general rule of thumb, you'd like to have 3 months worth of operating expenses. So in reserve, so cash, I'll say in liquid assets, so cash and investments, CDs, those types of things. So if your expenses are, we'll make it really easy, $1.2 million a year, so they're $100,000 a month. First of all, you would back out, in that scenario, you back out depreciation because you're not cutting a check for that. So in that scenario, if your 1.2 million is your annual expenses, ignoring depreciation, $100,000 a month, you should shoot to have a reserve of at least $300,000. So some organizations blow that out of the water. They have 6 months, a year, 2 year, whatever. Other organizations are 1 month and trying to build towards 3. But I think ideally you'd like to have, in that scenario, 300,000, 600,000 a half a year would be probably would be better and be a goal to shoot for. But yeah, 3 to 6 months, kind of a rule of thumb, to make sure that if you have unforeseen expenses that pop up or an unforeseen dip in revenue, that you're not running to the bank right away for a line of credit to draw on. In that scenario, you have those reserves to draw on first, to kind of cover that until hopefully things rebound.
Okay. I know we are at time. However, we do have one question that just came in that I think might be helpful for people to hear. So we will go a little past time if people have to drop. We appreciate you participating as always. And you do have Mike's contact information here on this final screen that you can, I'm sure, reach out to him and he'll be happy to answer particular questions for you.
Absolutely.
Mike, the last question we have is, uh, how do I encourage a finance committee and a board to not sweat the small variances? And don't sweat the dollars and look more at percentages or maybe timing perspectives.
Yeah, I think it's a great question because it is easy to get into the weeds on something that like, hey, that we budgeted this number and I just don't understand why. If it's especially if it's a number that seems like it should be very easy to estimate or exact in some cases, like rent. We know what our rent payments are. Like, okay, why is it not exactly right on? Well, we got to pay for some shared space, or we have to pay for some cleaning of the common areas or whatever. But it can be very easy to explain, but sometimes those small variances, people get hung up on them. We mentioned that kind of the variance, it was in quotes policy, have some sort of threshold where we even do this when we do an audit, is using a dollar amount and a percentage threshold. And if it doesn't exceed both of those, the variance doesn't even show up, if you will. So like depending on how you structure a budget versus actual report, either trying to get them to use that quote policy to just be, hey, we're not going to look at something unless it's over or under on both dollars and percentages. And then is there a way to even structure it so that the variance just doesn't even show up in the column unless it exceeds both of those, or somehow just highlighting it or bolding it or something like, hey, here are the variances that exceed our thresholds based on what we want to look at, and trying to avoid them. And then I think if in those scenarios, if somebody really wants to get into the weeds on something, even using those thresholds, and they still want to dive into that, I guess I would urge them to just say that's something we need to talk about offline. Like let's not talk about that extensively during the group meeting.
Fantastic. I think that's really good advice, highlighting percentages and continuing to talk about variance percentages as opposed to relative dollars.
Yeah.
Well, again, Mike, thank you very much for sharing your time, your expertise, and your experiences with us. I'm sure everybody participating found something they could take back and hopefully many things. Again, your contact information is included on the screen, and we appreciate all the support you provide for our community and especially our nonprofits and the partnership we've had with you in the past. Thank you very much, and we look forward to seeing everybody here again on the next webinar.
Yeah, thank you very much too, Peter. Appreciate the opportunity to present with everyone today.
Thank you very much, Mike.
All right, take care.